That's how the student loan in the US sounds like. The student debt from the US is 1.5 times the GDP of Canada. It's getting to be the whole GDP of Australia. We have an issue. We have a debate, a political debate about forgiveness or non-forgiveness of this loan. None of that matters. I grew up, like you probably, thinking and believing, because my parents taught me that education was the only thing or the best thing to do when investing in yourself, when you were thinking about having a future, how your future would look like. It would be shaped completely by your education. And yes, they were right. And yes, I did study. I got a PhD, so I studied for almost 10 years. But today, I wonder, I look around the United States, I look at these numbers, and I see everyone asking the wrong question. I'm here to take you to a journey, to ask the right questions about the student loan. So I invite you, parent, maybe like me, that has a 16-year-old in my case, or a 13. You're worried about them going to college, and you're worried about them not going to college, and you're worried about which college. Am I right? And you student who are being pressured by yourself and or by your parents, thinking if you should go to college and where to and what to study. And of course, you, recent graduate, that you're working. Maybe you are a lawyer like me, and you have found that maybe the job you got was not as good as you thought it was going to be, money-wise. I will humbly make a request. Join me in this journey. This journey is going to explain, or at least attempt to explain, the underlying economic impact and history of the student loan in the United States. And this will lead you to ask better questions. Are you with me? I really hope you are. Let's start this journey with a bit of economic history. And let's characterize this history by Mr. Welsh. We're in the 60s now. Back in time, Mr. Welsh was a retired Southerner who went to DC to work for the Federal Bank Loan Association. His boss, Mr. Fowler, thought he was not doing a very good job. When he demoted him, Mr. Fowler demoted Mr. Welsh and told him that, among other things, he would be getting a lower wage and he would be working alongside an African-American man. Well, Mr. Welsh just collapsed at the start of the story with a gun. He shot Mr. Fowler in the chest and later hung himself in prison. Mr. Fowler had to be replaced as the leader of the Federal Loan Home Association. In that time, in the 60s, there was a prominent man, Mr. Walker. Mr. Walker was the most famous lobbyist for banks in the whole of the United States. So he had a really big interest in naming someone in the Federal Loan Association that he could have a certain hold over. And that's when he found Mr. Edward Fox, a new character of our story. He went to Cornell, previously attended a very reputable boarding school. He was about 20 years old and had been working on Wall Street doing some really big deals. He liked a challenge. So he said, okay, yes, I will move from Wall Street. I will go to DC, leading this Federal Loan Home Association. How was the student loan, the rate of students looking in the United States? Congress wanted people to go to university for many different reasons. People thought that education was the way. And by that time, believe it or not, in the 60s, now we're going up to like 65, student loans had come to a halt. I know, right? To a halt. They had come to a halt for a very simple reason. Banks were giving student loans directly, and they had a cap on the interest rate they could charge. The interest rate they could charge was 10%. However, that was a nominal rate, meaning that did not take account inflation. And inflation, meaning the cost of living, was rising by more than 10% a year. Nominal interest rate, what happened was that the banks got less than what they had lent. So there was no interest and no incentive to give loans. In this scenario, Mr. Walker, remembered that he was a lobbyist for the banks, started lobbying in Congress with very good results. Congress did not know how they could lend money. It was a risky investment. Students not always pay. Also, remember that there was no limitation back then as to bankruptcy, refinancing, and everything else that today's students face. An idea hopped in their minds. And to make no mistake, this idea has everything to do with the books, meaning their liabilities and losses of the government and of the banks. So, a lot more to do with economics and finance than with any good or bad intent or good or bad heart when lending money to students. The figure proposed by Walker was the creation of an institution that was very similar to the Federal Loan Home Association back then called Fannie Mae. You may have heard of this in 2008. That's how Sallie Mae was created. Who was the CEO of Sallie Mae? You got that right, Edward Fox. But what's behind this, really? What happened was that Sallie Mae was created as an intermediary, as a corporation that was to be an entity between the government and the banks. The reason is Sallie Mae was not allowed, and it was not allowed until much later, to lend money directly to students. It was allowed to buy the student loans from the banks that had granted them, and also to lend money to banks and take the student loans as collaterals. By then, the collaterals were actually little papers or big papers, I'm not sure, and they kept them in a warehouse. What does this have to do with the books? The banks, if you have two columns, right? What you make and what you spend. This is really for everyone, right? So if you look into a company, you will always have at least those two columns at the same time. So the banks were spending all this money in student loans, and they were not getting great results like any other loan. They were not getting particularly bad results, but not great either. So what happened with these losses? Well, when Sallie Mae made the magic and bought the loans, Sallie Mae took the losses out of the banks, and the losses now were shown in Sallie Mae, in this intermediary. But that's not all of the story. As the story goes, the federal government was very worried that this debt was going to be irresponsible. In fact, there was a president, which I'm not going to name right now, saying that probably throwing money out of a plane and hitting people with it would be more assertive and would gain more returns than actually giving student loans to everyone. You see, the government, the Federal Reserve, and the government were afraid of what? They were afraid that when you look at their books, because they have books, so they have spending and they have what they make, for example, from taxes. They really didn't want to show that the taxpayers were actually funding the system. It didn't look too good for the election. So when Sallie Mae bought these loans, what also happened was that where did it get the money, right? Where did Sallie Mae get the money from? They got an investment from the federal government. So that way, the federal government, if you looked at the books of the federal government, meaning their spending and their gains, taxpayers' gains, right? That's what you and I pay. And here is the spending. That hand disappeared. Spending also disappeared from the books of the federal government. So no one would get into trouble, in the campaign. We are going into the 70s now, but banks still did not have a big incentive. I have to say, Edward Fox did his best. He rallied around the country asking banks to make the right choice, to do the right thing, to invest in students, to invest in education. But he was getting nowhere. In a move to counteract the situation, what happened was that the federal government and Congress established that Sallie Mae could borrow money by itself, and it could borrow this in the same terms as the federal government. What does this mean? The federal government of the United States and the Treasury bonds, I don't know if you've ever heard of Treasury bonds, but they're the most secure investment in the world. Now Sallie Mae could access the same borrowing terms as the federal government. So basically, they could borrow money for nothing. So they could lend a lot more. Banks were not yet that convinced. Actually, the federal government back then would only return 80% of the student debt, and they would not return any part of the interest rate. With the lobbying again, and Congress hearing this lobbying, because let's say no one here is in the clear, just you, because you're a very smart person. I'm sure you're in the clear. This was not enough. So Mary Whalen came in the picture in the late 70s. Mary Whalen was a 20-year-old, and she was known for her work that was so precise and detail-oriented that she could manage lobbying like no one else in the whole United States, basically. Mary Whalen played such a role in Congress with lobbying while she worked for Sallie Mae that she got Congress enacted this an assured 3.5 spread for Sallie Mae, whatever else. What does this mean? Sallie Mae would make 3.5% over everything it borrowed, everything it bought, over every cent. Back then, the interest rate that you could get on anything was 1.6% if you were lucky. So imagine how much money Sallie Mae was making with an assured 3.5% granted by the federal government, and of course paid by the taxpayers, but not shown in the book. Now, let's look at what the 70s going into the 80s were looking with all this benefit. We had tons of student lending, which was being guaranteed with the 3.5% and with their very cheap borrowing. We had this lending was being lent to students at different rate, because remember, Sallie Mae could not lend back then directly. So only commercial banks could. So commercial banks would lend the students, and the students would go to any college they wanted, to any higher education institution. The good, the bad, and the ugly. Okay? So that means, yes, there were many mistakes made. That's what it means. You know who did very well in this scheme? The universities. Universities started growing. In fact, universities started building gyms, building community centers, building sororities and all and all. It was not necessary at all for the teaching, for the institution. It was not about raising professor salaries, by the way. It was always about making more and more buildings, and started to actually have escrows, which they still manage, most of them. In fact, in this period, in the 80s, when we are going into the 80s, the 8 Ivy League schools were accused of fixing how much they charged students because they entered into a collusive agreement, which is completely illegal. MIT recognized this much. The others settled, so we do not know if this was true. And universities, they realized that the more they charged, the more students tried to get in. They did not see a decrease in the applications. They saw an increase in applications. You know what happened with inflation, and now I'm talking about 82. Just let's take this year as an example. In 82, the inflation rate, the cost of living in the United States, was 1/4 of the increase in tuitions that same year. Note that public universities also were double or triple the inflation costs. So you see how this is starting to look like a vicious circle. Federal government is not telling taxpayers, they are paying for everyone's universities, good, bad, ugly. Sallie Mae, as an intermediary, was getting very wealthy with these loans. Banks, commercial banks, were getting very wealthy with these loans because they were, by then, all these restrictions about asking for bankruptcy or refinancing and all these things that they are very, very extremely hard to do. And for students, well, it was a no-brainer. We have been told every day of our lives that education is our way out of poverty, out of the vicious circle. But you know, universities, they were the only ones in this system that did not have any skin on the game. They still have no skin on the game. The Carter administration did not see this as so good, started to question what was going on. The lobbying again was so good that in 1980, Congress opened Sallie Mae to Wall Street. Sallie Mae made its first initial public offering and joined the New York Stock Exchange formally in 1982, and its debt was ranked AAA, the best kind, by all the credit rating agencies. Okay, this is very relevant. Why? Because remember 2008, remember, if you are old enough, remember there was a big financial crisis? Well, that financial crisis was because the loans given out for buying homes, okay, were excessively irresponsible. So they would give these loans to anyone. But that was not the problem at all. The problem was that these loans were in the form of securities. What is a security? Well, the best way I can explain it is, imagine you have a debt, and you have a debt from someone who is paying their house, is doing well, everything is going okay, and you have someone who has no income whatsoever, has never worked a day in his life, has gone into your bank and has said, I want to buy a house, and you said, okay, fine, go with it. And so we have these two people, right? And we have these two papers, these two pieces of paper. This is person responsible, and this is person not so responsible. This is what we call the subprime loan. What happens was, these two papers, we tear them up in small pieces. And let's say we have a bottle, and you start to put in pieces of the bad loans, of the irresponsible, no job, responsible from the bank. No job person, never had a job ever, no intention to pay whatsoever, and the good ones, some of them. So you put 3 bad, 4 bad, and maybe 1 good. Then you put 4 bad and 1 good. And then you mix them all and you say, let's call this a very complicated name because then no one will ask. CDS, they called it. It was a security. That is what a security is. And the problem was that since no one understood the security, everyone bought it. And by everyone, I mean everyone. All the banks in the United States, in overseas, in the UK, in Germany, in people, like natural, normal people, like you and me, bought the CDS. And no one really bothered to ask what they were doing. No one really bothered to know what the CDS contained because it was so good and so complex, so it must be true. That's the point. The point is, the system for the student loans was also securitized. It was also sold and is still sold in securities. How many securities that regard student loans are out there right now? Out there, I mean in the New York Stock Exchange, I mean everywhere, I mean rated AAA by everyone, okay? We do not know. We only know that 92% is from the federal government. And they are out there, they belong to people. And the point is, people, that no one ever asks the right questions because they think that if they don't understand, well, they are the ones on the wrong. And I'll just say this once again, I promise. If you do not understand what you're getting into, okay? And you go to your financial aid officer in university, you go and speak to the bank, and you go and speak to everyone or anyone you can find, and you still do not understand. If someone cannot explain something to you, like a 10-year-old, and the 10-year-old would understand, that only means that that person is lying. That person does not understand what they're saying. And you, when you believe them, you're falling in the same fraud. Here is the problem. The real problem is not if you have a president that wants to forgive loans. It's not about that. It's not about Biden's forgiveness plan. It's not about Trump's. It's the fact, people, that this is a loan that isn't the size of Australia, and it is, in fact, owned by the government through securities owned by everyone. So, if they were to forgive the loan, that makes no economic sense. You have to think in economic terms. Why? It's impossible, because that means that the student loan is too big to fail. It's the only one. You know, banks in 2008, they didn't let them fail. Some of them they did. They were too big to fail, and later too big to jail. But student loan is too big, way higher than the home loan crisis of 2008 and 2009. Way higher than the credit card loan and the car loans owned by all the United States of America, 3 times more. And these are being sold to people like you and me and banks and whoever else. So let's say in the mind, because this is the thing, if you do not understand, do not ask the right questions. So let's say some of these candidates or some people say, okay, let's just forgive this. Okay, first of all, you would cause a financial fallout the size, I cannot imagine what size that would be, because the precedent of the biggest fallout in history, contemporary history, besides 1929, was the financial crisis of 2008 and 2009. And this would be 3 times higher than that. And how many people would you be? Would you be leaving with nothing? That's one thing. All the owners of those securities, first. And second, 92% of this loan is today in the books of the Federal Reserve. I told you this. 92% is owned directly by the government after Clinton decided to make it transparent. What does that mean? That if someone today were to forgive the loan with these are considerations we cannot really, they're not debatable, okay? So if someone was to forgive all these loans, what would happen is that a debt the size of Australia would be released in all the United States. Forget securitization, forget that. Forget of all the investors that would be led to ruin. And when I say investors, I mean all people, pension funds, I mean everyone, okay? But let's forget that. Let's pretend it doesn't exist, because that's easier for politicians. So much easier. Having the debate of what's good to respond for loans or not. People, it's the size of Australia. If that happens, do you know the inflation rate that could cause? That would get the United States ruined, because people will have so much disposable income freed up that inevitably the money circulating would be so much higher, and the inflation rate, I think, will get to maybe uncontrollable levels. Only the Federal Reserve can make an estimate of that. How would that look like? If that happens and the inflation grows to that rate, you know what happens to the United States of America? Well, the United States of America, with all the problems we have today, is still the superpower of the world. It will cease to be the superpower of the world. Remember, if the dollar is worth nothing, if the dollar goes down, the whole United States goes down. The solution is to drive universities to be responsible for what you're doing. It's the solution to say, be responsible. It's the solution to change the market so that you do not require a bachelor degree to be an administrative assistant like it used to be, because you do not need a bachelor's degree. We are in an impossible situation. But I can tell you this. After everything I have said, I do have one thing I can help you with, and that is ask the right questions. If you have a loan, ask exactly who owns the loan, how it's going, even if it takes you 525 minutes on the phone waiting for someone to take your call. Do it. Do the math. Look at the numbers. And decide where you should start paying first when you get a job. So people, look at the numbers. I know it's scary as hell. I know that. But you know what? We all have to push together when we ask these questions for better public policy. That is the solution. A better public policy that gets everyone involved in the solution, including universities, including everyone. And look at the numbers when you do that. And should we go on doing the same? Because this is the other question. Because this is continuing the same exact structure. There's No difference whatsoever. If you like this content and you're still here, thank you. But please press like, subscribe to my channel. I honestly hope this was useful to you.